So the SPX got his buddies together, the QQQ, the DIA, the IWM, said, hey, let's meet at the 200. What's going on, everyone? Jeremy Ritz here. Courage pays better than fear. Did you like my stock market joke there? I hope that you did. I just thought of that here on the fly because on Friday, many of the broader markets nearly came down and touched the 200-day simple moving average. And the weakness continues in the broader markets. We're seeing selling continue because the war, the conflict between the United States and Iran continues. We learned on Friday that the United States was deploying Marines over to the Middle East, and there is still uncertainty as to whether or not this conflict is going to intensify and grow into something greater. And while the SPX and its buddies did not touch the 200, it is very close. And I would not be shocked if on Monday we have another repeat of what we saw last weekend, where we gapped down hard. We are below that 200, and then as it starts to climb up and buyers come in, what is now going to function as resistance, you guessed it, the 200 simple moving average on the daily. And we know that this shock, this pressure to the downside in the markets is a natural outflow of war. You could just go back historically and look at it on the charts from any conflict that you want to pull up, and you can see that the immediate response, especially Middle Eastern wars or wars that involve oil, do have these types of pressure to the downside on markets. So it's just a common thing. However, what always follows from these drops, you guessed it, is a move higher. So any weakness that we're getting right now is temporary. And here's the other part. The market was overdue significantly for a drop. And here's the thing, we're just below 5% on the SPX. And we have much further that we can fall to the downside. 10%, 15%, 20% is considered a correction. It's only after you go deeper than 20% that you get into bear market territory. We'll see if we're going to get something like that. And then there's also the component of taking out the December lows when we talk about seasonality. We did do that. We closed below those lows. That can be an indicator that there is weakness ahead for the markets. So that doesn't line up in favor of the bulls. And then again, we just look at the valuations of a lot of these companies. They're still very, very high. And a drop, a dip, a correction is not a bad thing. So where do we go from here? What is next week going to have in store for us? We will have to see. I have not completed my full chart study. That's going to happen here shortly, and I will have the Sunday setup video out there for everyone to check out. But again, we just have to monitor what happens with this conflict, the Strait of Hormuz, or however you pronounce it. I suck at pronunciations. That continues to be a sticky wicket for this whole process, because if that is restricted, the movement in and out of oil from the Strait is going to pressure things to the downside. So really, resolution, clarity around what is happening with this war is what is going to be needed for things to begin to move higher again. I will say this. There are several things out there that before this weakness even started were already on sale. We're already destroyed. We're already beat up. And you have to wonder if a lot of the Mag 9, which is still hanging in there, it's still pretty highly valued, if we'll start to see those things come down, but see money start to rotate into these depressed stocks, talking about software companies and some of the other speculative companies, because this should not be a long-lived issue, right? This is still the AI supercycle, and this should be nothing more than a temporary bounce. Now, it doesn't mean it's going to be over right away, because like I talked about with the Gulf War from 1990, you saw how long that persisted and lasted. And so we could be in this downside move for quite some time before a bounce comes in. So the best thing to do is plot out your levels, have your shopping list drawn out, keep your dry powder on the sidelines, and be ready to deploy it when the time is right. So that's what I got for you. And what do I think? What do I think is going to happen? I talked about earlier this week that we continue to get these massive drops. We buy it back up. We are retesting into the 10-day exponential moving average, and then we are coming back down, and we are taking out the low of the candle where we get the bounce on. So we saw it happen this past weekend. Big old drop over the weekend. Everything looked grim when futures opened up on Sunday night. The bulls bought it back up. It looked like things were going to bounce. But what happened on Friday? We took out that low. So let's see if we continue to repeat that pattern. On Sunday night, futures open, we drop down significantly. The bulls bounce it up on Monday during the day. We push it up into the 10, reject, come down, and take out the low. Let's see if that continues. I think there is more weakness ahead for us. Until the SPX corrects 10%, I'm not convinced or ready to go long on anything in terms of a swing trade. That doesn't mean that I'm not DCAing into other positions that I have, but in terms of swing trading, that's what I want to see first. Let's get that 10% on the SPX, and who knows, that could come as early as next week. So that's what I got for you here on this episode of Driven. Have a phenomenal Saturday. Thank you for your support of the channel. We had a great turnout, great number of views this week. That means so much to me. My appreciation to all you guys, gratitude to all of you. Love you guys. Have an amazing day. And as always, can't forget my tagline: make it a great day, honor the moment, and most importantly, be grateful. Take care, everyone.